Hey everybody, DayTraderRockStar here, and bringing you a special video that's part of our Ultimate Divergence course. It's also part of our business plan. It is such an important part. I did record some videos and we went over this, but I want to go over it a little bit more detail. And what I'm talking about, and again, I'm going to just start off with the business plan. I think that over the last few weeks we've been talking about making a business plan for your trading methodology and how important that is, because trading, what we do is find the best setups, and if you have to stay within that path, because that path is the path of winning and being successful. Once you go outside that path, anything can happen. You're just going to take away the odds. You have to be a machine. So having something like a business plan or a methodology written down really keeps you tuned in and keeps you on path. So that's what I did, and I showed you exactly how I broke down here. And this is just a great blueprint. If you're beginning to trade and you want to trade our divergent style setups, the HPS divergent styles, this is how I would do it, and it's all marked out here. So I like I said, I went over it. I did a couple of these videos for Day Trading Radio members already. We talk about just what we're trading. Then I go into the divergence method. And what my formula is. But the part that we're going to talk about today is how many contracts should you trade? That's a great question that people always ask me, and it's it's an easy one to say. I think it should be over one. It should always be 2 or more contracts to take advantage of such the good setups, and we'll talk more about that. But it really depends on how much money you have too. In your account and what you're trading with and what you need. So that comes into play. That's your first factor. So we're going to talk about that today. Kind of give you a nice chart on it. I want to bring up that chart right now. And we'll talk about, what steps, what you're looking here on the chart, what it means, and how you can use it to build. And it kind of gives you an idea of how far you want to go, and what time, at what point do you take that next step and you add on to more contracts into your trade. So this is all done for you right here. So that's what we're going to go over today. I hope you enjoy this. All right. So the first thing you're seeing that this is position sizing for DTR's high probability methodology, the HPS divergence strategy, right down here. And this is a great little spreadsheet. Everything's calculated in. And we're talking about using this technique trading the ES. Now, I could put the NQ in here. I could do other things. But we're going to use the example for the ES. We could also do it for the NQ, YM, whatever. Just use the blueprint, and you'll understand how it's going. Account size when we start. What is the minimum account size? That's a tough question too. I mean, you always, I'm not even going to get into what it is, but we're going to just start off with the minimum that you could technically, because you're going to be buying contracts and stuff. So, I mean, I always say $5,000. That gives you plenty. You could actually start an account with $2,000. That would be the minimum, but it wouldn't. I would just say you're pushing your limits. First of all, especially if you're a newer trader. This is not easy. We might make it look easy because I'm actually showing it in a good way, but to exercise all the just to exercise it and to apply it is hard. It is. It's just so many emotions in the market, and when you see something, sometimes you just don't set it up. But if you did, this is how you would do it, and we'll just move on here. So here you have the position size. Let's start off with an account size of $5,000. Trading the ES, and it's broken down here. 1 point equals $50 on the ES. And what we're going to talk about here, margin. Margin is basically intraday day trading margin that you can buy an ES contract for. Now, all the brokers are different. IB's over $1,000, $2,000. You have Apex, which is $500 margin, and other ones are in between that. I think Gain Capital might be actually $500. Stage 5 is 50% of the exchange margin, which at the time of that writing was about $5,060. So that would make it $2,500 would be their day trading margin. And the same thing. So everyone's a little bit different. They usually do a percentage based on that. But if you're, like I said, you get Apex, Gain Capital, some other ones that give you $500 per contract. So if you had, let's put this down to we're going to actually start this with $500 on our contracts, our margin. So this is, each contract would cost you $500. You could always move it up. Want to fix it? Boom, everything goes. So my maximum position size would be 10 if I had an account size of $500. Or I mean, a margin was $500 per contract. I would be able to get 10 contracts. All right, so let's move on. Now, our risk level. How do we know what the risk level is? Well, that's when we're talking about the HPS ultimate divergence method that we're trading. The stop or the risk is already defined for you. That was the big thing about. Let me get rid of this. That was the. Let me bring up my other chart here. Our risk is already defined in the methodology, so I want to go back to the business plan here because everything is here. So we have our entry levels. We have what to do to prepare for a trade, what time frames we should confirm, a place in the trade. But where do we place our stops? All right, one tick under the second stage divergence for a long, and one tick above the second stage divergence high for a short. So basically that's defined. Now what's good about that, and adding it to this, sometimes you could get those weird candles that really spike and almost might be two-point risk. If you actually saw a big reversal candle, gave us a divergence, closed quickly on the opposite side of the candle, and by the time you got in, you're actually a point away from that divergence low or high. Could it move so fast? So you could actually refer back to the chart to see if you should take that trade if it falls within your acceptable risk management percentage. And I'm going to use percentage at this point right now, even though we have a set criteria how to get out of our divergences. That's the best way to do it, and hopefully it stays within this range. But this is another way of doing it, and you could also apply this to other ways of trading. So we have our $5,000 account. One contract would cost us $500. Our maximum risk is about 2.5% of the account value. All right, the account value. Per trade. So you don't never want to risk more than 2.5%. The fixed one, we're really talking about 2%, but the max at 2.5%. And I could actually, I want to say you could actually go up to 3%, but we're talking about beginner traders. Now, if you're a beginner trader, what would you want to be taught? It's going to be hard to pull away from that, the little gambling urge in you to push things a little bit further and trying to gain. I understand that. We're all going to do that. I do it too. But, when you start off, it's not going to be, there is a learning curve. And the majority of most people are going to lose money before they start to realize it. We're trying to cut the curve down here. I'm really drastically cutting a lot of time off that learning curve just by explaining all this. But most people have to figure it out themselves, You could show someone something, but they have to go about and find it out themselves usually. They have to take that journey in the market. And it's a painful one sometimes. All right. So, but never give up, because you'll eventually, if you're watching this video now or you watch some of our other videos or trade with us during the day, then you know the real deal. And all it is, it's, the passion now just for the next great setup. So this is a little bit more of a detailed way of keeping a risk management profile on your whole methodology. So, all right, so you're going to use a 2%, basically a 2% risk on your portfolio, percentage of your portfolio per trade. So now we're going to say, here's your position. Remember, you have an account worth $5,000, and you don't want to risk more than 2% per trade. So you could go down 2% of the account. Here's 2%. Go over. That would give you a position size of 2. So you're able to, that's why this would be the minimum, because you want to always trade with more than 2 contracts. So at this point, you have you're trading with 2 contracts. That 2 contracts gives you that $100 risk, and it gives you that 2% of the account. Now, per contract, we're going to do that. Well, no, actually, we're good like that. That's based off of 1 point. All right, so your point is really, that's going to give you that 1 point. So that 1 point, does that fall within your divergence stop? Lots of times your divergence stop might be more than a point. It might be 1.5 points. So you're going to go a little bit above that. I prefer to stick to the divergence rules than these, but as you go on, and what this is going to also help you do is determine when you're going to step up to the next level. So you're going to continue to make money. You're going to stay true to the methodology. You're going to apply all the rules, and you're going to be disciplined, and you're going to make money. And next thing you know, your account size is going up. So and I always say the first thing you should do, and again, I'll say it on this video too, start off in a sim mode with a $5,000 account. And just what I'm talking about right now. Start off in a sim mode, whatever, is going to give you that sim mode, and trade the methodology. Trade it. Stick to it. Trade it. Once you double the account, then go live. And that would probably give you, a fighting chance in the market. All right? And it'll be much different on the sim mode. You're not going to have the stress and some of the other emotions running wild that traders have to deal with. But if you apply, and that's going to give you enough time and enough discipline, some experience in applying a method to something, especially for the newer traders out there. It's just something that I wish I knew in the beginning. So as you then make your new account and you eventually get going higher and higher and higher, as you break those thresholds, or just calculate it, say you're up to $7,000. Oh God, I just lost my, there it is, $7,000. Now we've moved up to, almost 3 contracts. That would be 2.14%. So we've moved up out of 2 contracts to 3 contracts, and staying within that risk management zone, that 2% risk. And again, you could keep it sharp at 2% and say, well, I can't get there. I can't move up to 3 move up to 3 contracts until, and we'll see what happens when we put a 5 in here. 7,500. There we go. Wow, perfect. 7,500 would bring us up to 3 contracts. So if you want to apply that to 3 contracts. Now, this is all done for you. And again, you can pretty much see as you go higher and higher with your account, you're going to apply the same methodology to the setups. And you're going to have enough confidence that, eventually you're talking, $22,500 your account is, and then you're up to close to 9 contracts per trade. For 1 point on that 9 contracts, you make $450. $450 per point when you're trading 9 contracts. It's not bad on a method that gives you a 85 to 90% success. If you stick to the criteria and place your stops where you are and don't do anything else, I think that's a good gamble right there. So this little segment here is doing 2 things for you. It's telling you when you can move up in a stage and when you should start adding contracts to keep your risk management levels the same. The other thing is applying a good risk management profile to your trading. In this case, we're using 2%, but you could change this. You could make your acceptable risk 3%, and all these things are going to switch up for you. So let's move that to 3%. That was a change in the fixed risk table here. So I moved it back to 2%. And what this is doing for you right now over in this little table, it tells you right off whatever your account size is. And I moved this account size down to 2,500. I was just messing with it before, but as you can see, when I move it around and I move it back up to, well, let's see here. Let's say we're going to actually stay at $2,000. You're opening up an account for $2,000. So with a $2,000 account, you're automatically over that 2% risk management level. So let's move it back up to 5. And 5,000. This box automatically kind of calculates what your account size is, and if, of course, if you have one for a 2% to be, again, this is fixed, and here's your fixed 2% risk management. So $10,000, one position size would give you 4 points risk. So if you look over here again, here's your one position, and if you go out, here's 1 point, 1.5, 2, 3, 4 points of risk. One contract. Remember, it's one contract. It is $200 or 2%. 2% it is, and that's what it is. If it had two contracts, you're holding two contracts, then it would give you a two point stop, basically. So here's your two contracts over here. If you went over, you just go over to where the 2% is, and this is based off of a $10,000 account. All right. So if you were just using that one fixed thing for, it kind of just calculates the contracts and how many points per contract. I want to move it up, but let's move it back down here for a second. We'll move it back to 5,000. That's changed. You'll see one contract. You have 2 point risk on on an account of 5,000. If you bought two, of course, you only have that 1 point risk. So that's kind of a different way of looking at it. Two contracts, 1 point risk gives you that 2% fixed risk rate. Again, versus using the divergence stop strategy, the criteria of the second divergence, high or low, and using that stop above that. So measure them both out. But this is, I think, even better just to kind of tell you when you should progress to the next level by using the just moving the account size up and using that 2% level to determine when you're able to go up in position size, which is on your left-hand side here. You'll see it slowly start to move as your account goes up. So I think that's really good. So if you have any questions, you know where to find me. All right. This is actually a, just another part of the whole system. It's an important part of the system. I hope you gained from it. If you want to learn more about it, it's the HPS Ultimate Divergence course. I actually have a whole course on it, and I also teach it live every day at Day Trading Radio on the air. And that's how we trade. So you can come by Day Trading Radio. You can go to theschoolofstock.com and check out the Ultimate Divergence course there. And we'll see you in the markets every day. All right.